Welcome back, everybody. We're diving into the fascinating world of value investing today. You've all sent in so many excerpts from value investing, from Graham to Buffett and beyond. And I gotta say, I'm really intrigued by this whole idea of unearthing hidden gems in the market.
Yeah. I think we all kind of wonder if, we can really beat the market by being like savvy shoppers.
Right. Like, is it truly possible to consistently find those undervalued companies that everyone else seems to be missing?
Well, that's the big question, isn't it? And the book really digs deep into that. See, value investing is almost like this contrarian approach. It's about tuning out the noise, all that hype about the latest trends and really focusing on the fundamentals. It's more about like careful analysis and patience.
That makes a lot of sense. But how do we even know where to start? Like, where's the map to find these hidden treasures in the market?
Well, the book actually traces the roots of value investing all the way back to this classic book, Security Analysis, by Benjamin Graham and David Dodd, published in 1934. It's considered like the Bible of value investing for a reason. And one of the key principles it lays out is this idea of intrinsic value.
Intrinsic value. Okay, so what's that all about?
It's about looking beyond the sticker price, the market price of a company, and figuring out what it's really worth based on its underlying assets, its earning power, its future potential. It's like, peeling back the layers of an onion.
I like that analogy. So, how do we go about actually calculating this intrinsic value? It's not like there's like a formula, right?
Well, there are definitely frameworks and methodologies, and the book outlines a few key approaches. One way is to look at asset value. Imagine you had to rebuild a company from the ground up, right? How much would that cost? It's about taking inventory of everything, tangible and intangible. You've got your factories, your equipment, your inventory, your patents, even the brand reputation. All of those contribute to a company's asset value.
So, if a company owns, say, uh, a massive plot of land they snagged for steel decades ago, and now that land is worth a fortune because it's prime real estate, that would seriously bump up their asset value, even if their current stock price isn't reflecting it, right?
Absolutely, you're spot on. It's like uncovering hidden treasure on a company's balance sheet.
Yeah.
And that's just one piece of the puzzle.
Okay, so what's the next piece? How else do we assess this intrinsic value?
The next piece is what we call earnings power value, or EPV. It's all about looking at how much profit a company is consistently churning out right now. Not some, pie in the sky future projection,
Yeah.
but the cold, hard cash it's generating based on its current operations and competitive edge.
So it's like evaluating a machine, right?
Yeah,
How much money can this machine reliably generate? Only in this case, the machine is an entire business.
exactly. Some companies are like well-oiled machines, incredibly efficient at turning revenue into profit.
Yeah.
That's a key factor in figuring out their intrinsic value. But of course, we can't ignore the future.
Yeah, that's where it gets a little tricky, right? Predicting the future is never easy.
Definitely. And that's where the third element of intrinsic value comes in, which is growth value. But here's the catch. Not all growth is created equal.
I was just going to say, the company can be growing like crazy, but if it's burning through cash like there's no tomorrow and not actually turning a decent profit, that growth might not be worth much to investors.
Precisely. That's a key point the book emphasizes. Sustainable growth, the kind that adds real value, needs to be profitable. It needs to generate returns that outweigh the cost of that growth.
Okay, so we've got these three pillars of intrinsic value assets, earnings power, and growth potential. But there's this other concept the book keeps mentioning that I'm curious about. Franchise. What's a franchise got to do with investing?
Great question. In the world of investing, a franchise refers to companies that have built this durable competitive advantage. They've got what Warren Buffett famously calls a moat. It's like a protective barrier that keeps competitors at bay and helps them maintain their profitability over the long haul.
Okay, so I'm starting to see the connection. It's about companies that have this unique edge, this staying power that makes them more valuable than their competitors. But what are some real-world examples of these moats?
The book mentions Coca-Cola. I mean, think about it. What's stopping someone else from making a cola? Technically nothing. But Coke has this incredible brand recognition built over decades. People trust it. They love it. That's their moat. It's almost impossible for a competitor to replicate that. Another example, WD-40. Simple product, but they basically cornered the market on it.
So a franchise in investing terms isn't about like fast food chains. It's about finding companies that have this way of fending off competition and protecting their profits.
Exactly. It's a key part of value investing, identifying these franchises. It's about finding those businesses that aren't just undervalued today, but also likely to keep generating solid returns well into the future.
This is all making a lot more sense now. But I gotta ask, how does all this theory actually play out in real life? I mean, these concepts sound great on paper, but how are successful investors actually using them to make money?
That's where things get really exciting. The book dives into the strategies of some of the most legendary value investors, showing how they've used these principles to achieve some pretty amazing results. Shall we take a peek into the minds of these masters?
Absolutely. I'm especially curious about Warren Buffett. Everybody knows the name, but I'd love to understand what makes him tick as an investor.
One of the things that really stands out about Buffett is his discipline. He's incredibly focused on staying within his circle of competence. He avoids investing in things he doesn't understand, even if everyone else is jumping on the bandwagon.
It's a good reminder that you don't have to be an expert on everything to be a successful investor. But how do we define our own circle of competence? Like, what are some questions we can ask ourselves to figure out what we truly know and what we don't?
That's a great question, and a crucial one for anyone who wants to get into value investing. Maybe we can circle back to that later. But sticking with Buffett, another key part of his philosophy is how he thinks about risk. He doesn't see risk as the stock price going up and down every day.
Wait, really? I mean, most people I know, they freak out if their stocks drop even a tiny bit.
Right. But for Buffett, risk is about losing your money permanently. So he looks for companies that are so undervalued that even if things don't go perfectly, he's unlikely to lose money in the long run. It's about that margin of safety, buying at a price that gives you a cushion.
The book actually tells this great story. Buffett asks, would buying a company that's worth $400 million for just $80 million be any riskier if its price suddenly dropped to $40 million? It really makes you think differently about risk.
Totally. Buffett is all about challenging conventional wisdom and encouraging us to think for ourselves.
So, okay, Buffett's all about deep understanding of the businesses and buying them at a discount to minimize his risk. But are there other approaches to value investing that work?
Absolutely. There's no single right way to do this, and the book highlights that by profiling other successful investors who take different paths. Let's talk about Seth Klarman, for example. He's known for finding value in these unusual places, often where others are selling for reasons that have nothing to do with the actual business itself.
You mean like when everybody's panicking and selling off their stocks, he's the guy swooping in and buying them at a bargain?
You got it. He looks for what we call motivated sellers. Like a fund that's forced to sell shares because of some rule, or companies going through a rough patch that scares other investors away.
So he's a contrarian, huh? Going against the herd and finding opportunity where everyone else sees problems? But isn't that kind of risky? I mean, what if those problems turn out to be worse than he thought?
There's definitely more risk involved with Klarman's approach compared to, say, Buffett's focus on those blue chip companies. Klarman sometimes invests in emerging markets, which can be very volatile. But with that higher risk comes the potential for much bigger rewards.
Makes sense. High risk, high reward. But it seems like both Buffett and Klarman, even though they do things differently, share some key traits. They're patient, they do their own research, and they don't let the market's ups and downs rattle them.
You're absolutely right. Value investing is about having the right mindset, being independent, doing your due diligence, and playing the long game.
Okay, so let's say we've done our homework right. We've used these approaches to find some potentially undervalued companies. Now what? How do we actually go about building a portfolio? How much diversification do we need as value investors?
That's a great question. Something a lot of investors grapple with. And you know what? Value investors tend to have portfolios that are more concentrated than what you see with the average index fund. They're not spreading their bets across hundreds of companies.
Why is that? Isn't diversification supposed to reduce risk?
It is. But remember, value investors, they only invest in companies they really understand and believe in strongly. Their research and that margin of safety we talked about, those are their risk management tools. They believe that spreading yourself too thin can actually dilute the power of your best ideas.
So they're saying diversification can hurt your returns if it leads you to invest in companies you don't really get. But isn't there a risk to being too concentrated? What if one of those picks goes bad?
That's a valid point. There's definitely a balance to strike between concentration and diversification. Too much of either can be a bad thing. But the takeaway here is that value investors, they prioritize quality over quantity. They would rather own a few really great companies they know inside and out than a bunch of so-so ones they barely understand.
It's like focusing on the main course, right? Instead of filling up on appetizers.
Exactly. That focus, that laser focus on high conviction investments, that's a hallmark of value investing. It's all about, concentrating on those companies where you've done your homework. Now, the book also dives into some other really interesting investors who've used value investing, each with their own little twist.
Oh, this is where it gets really juicy. Lay it on me. Who are some of these other value investing gurus?
One that comes to mind is Glenn Greenberg. He runs a very concentrated portfolio,
Yep.
and he's all about companies that generate a lot of free cash flow.
Free cash flow. Okay, I've heard that term, but I'm not sure I totally get it. What makes it so special to investors like Greenberg?
Well, you can think of it this way. Free cash flow is the cash a company has left over after they've paid all their bills and, reinvested in the business. It's the money they can use for things like dividends, buying back their own shares, or even pursuing new opportunities.
So it's not just about profit, it's about how much usable cash they have on hand. Gotcha. But why is that so important to Greenberg specifically?
He sees it as this key indicator of a company's financial health. Their ability to actually create value for shareholders. It's a more tangible measure of profitability than just looking at their earnings, because earnings can be, well, manipulated sometimes. Greenberg wants to see the actual cash coming in.
So he's looking for companies that aren't just profitable on paper, but are also efficient with their money.
Exactly. And that ties into another big part of his strategy. He's all about doing his own homework. He digs deep into their financials, pores over their annual reports, and really tries to understand their business model inside and out.
That's what I love to hear. It means you don't need to be some Wall Street hotshot to make smart investment decisions. So much of investing feels like this big mystery, so it's inspiring to see someone who takes such a hands-on approach, just rolls up their sleeve and gets to work.
It really does demystify it, doesn't it? Now, if you're looking for a truly unconventional approach, let's talk about Robert Heilbrunn. He kind of took a different path.
Ooh, I'm intrigued. What made him so different?
Instead of picking individual stocks, doing all the analysis himself, he actually invested in other value investors. He believed the best way to find those undervalued companies was to trust the expertise of guys like Benjamin Graham, Walter Schloss, even Warren Buffett himself.
He basically built a portfolio of talent. That's amazing. It's like outsourcing your stock picking to the best in the game, but wouldn't that be insanely expensive? I mean, these guys probably don't manage money for free, right?
It does come at a premium, yeah. But Heilbrunn believed it was worth it. It's like paying for their knowledge, their insights, their track record. It shows that investing isn't just about the numbers, it's about the people too.
It's about finding the people who have that sixth sense for value and then hitching your wagon to their star. It's like, if you want to go fast, go alone. If you want to go far, go together.
Perfect analogy. And speaking of going together, the book profiles Walter and Edwin Schloss. They were a father-son team who had this classic buy cheap and hold strategy.
Now that's a strategy I can get behind. Simple and straightforward. What was their secret sauce?
They were super disciplined, very strict about buying stocks that were trading for less than their net working capital.
Hold up. You're losing me a bit. Net working capital. What is that, and why were they so focused on it?
Okay, imagine you had to sell off all of the company's assets today and then use that money to pay off all their debts. Whatever is left over, that's their net working capital. It's a pretty conservative metric, and it focuses on the company's liquidation value, what you could get if you had to sell everything right now.
So the Schlosses were looking for companies whose stock price was so low that they were basically trading for less than the value of their assets minus their debts. They were getting a steal even in the worst case scenario.
Exactly, buying with a huge margin of safety built in. And then here's another key thing. They held onto their investments for an average of 4 years. They just ignored all the short-term noise in the market.
Talk about playing the long game. Just letting their investments grow over time. It sounds almost too easy. But I guess that's the thing about value investing. It's not about being fancy or complicated. It's about discipline and being patient.
Couldn't have said it better myself. But, I got to be honest, I wonder if this whole buy cheap and hold thing is it still relevant today? I mean, information spreads so fast these days, it makes me wonder if those truly undervalued companies are even out there anymore.
Yeah, that's a fair point. It's definitely gotten tougher to find those deeply undervalued gems in today's market. But the book suggests that investors who are willing to venture off the beaten path a little into the world of small and microcap stocks might still find some good opportunities using this approach.
So smaller companies that are maybe flying under the radar of those big institutional investors? Exactly. These companies tend to be less researched, which can create those inefficiencies in pricing that value investors love. But fair warning, it takes a lot of digging and uh, a higher risk tolerance to play in this space. You really need to trust your ability to figure out the company's true value.
It's like panning for gold, right?
Hey,
A lot of effort to sift through the dirt, but the payoff can be huge if you find that nugget. This is all super interesting. Does the book talk about any other investors who specialize in these less conventional corners of the market?
it does. The book wraps up with a profile of Paul Sonkin. He's got this knack for finding value in, well, let's call them ugly companies. Companies that have been beaten down by the market for one reason or another.
Oh, I love a good underdog story. It's like rooting for the team everyone else has given up on.
He's definitely a contrarian, that's for sure. Sonkin is really good at finding companies that are facing some short-term problems, but whose core business is still strong.
Right.
So he might invest in companies that are, restructuring, maybe dealing with legal issues, or even those that have just had a string of bad earnings reports.
So he's looking for situations where the market is basically freaking out over bad news, and that creates an opportunity for him to buy valuable assets at a discount.
Exactly. He's betting that the negativity is overblown and the company will bounce back eventually.
Hmm.
He's known for investing in broken IPOs, for example.
Broken IPOs, you mean those companies that go public with all this hype, but then their stock price just tanks?
Those are the ones. Sonkin sees them as hidden gems. He believes that in some cases the hike was actually warranted, but then the market just, lost patience or overreacted to a few setbacks.
It's like finding a beautiful antique at a flea market that just needs a little TLC. The craftsmanship is still there, it just needs a little love.
Great analogy. And, it really highlights this key principle of value investing. The idea that the market isn't always right. Sometimes fear and panic can drive prices down to irrational levels, and that creates amazing opportunities for those who can see past the headlines and understand the true worth of a business.
It sounds like Sonkin is a master at separating, the emotional reactions from the cold, hard analysis, which makes me wonder, how can we get better at spotting those moments of market irrationality? It's so easy to get caught up in the herd mentality.
That's a great question, and it gets to the core of what separates those successful value investors from the rest of the pack. It requires this detachment from the day-to-day ups and downs and the willingness to trust your own research and your own judgment.
It's like being a detective, right? Looking for clues everyone else is missing and piecing together the story to uncover the true value. This whole deep dive has been so insightful. But I still have one question. We talked about how value investors like to have these concentrated portfolios holding fewer stocks than a typical index fund. Doesn't that seem risky? I mean, don't we need to diversify to protect ourselves?
That's a great question. It's something that a lot of people ask about. And it
Oh,
really gets to the heart of how value investors think about risk. Well, they believe that all that research they do, that margin of safety, that's their risk management. By only investing in companies that they really truly understand and believe are, significantly undervalued, they're basically mitigating risk through knowledge and careful selection.
so it's like their diversification comes from how deeply they understand each company rather than just spreading their bets across a ton of stocks.
Exactly. They believe that if you spread yourself too thin, you might end up investing in companies you don't really get, and that can actually make you more vulnerable. Instead, they focus on a smaller number of companies where they've done their homework and they have that strong conviction.
That makes sense. It's about quality over quantity, right? Like choosing a few amazing dishes instead of trying to eat everything on the buffet. But I don't know, wouldn't that make it tempting to try and find those companies that everyone else has missed? To go into even riskier areas of the market? What about short selling? Shouldn't that be a natural strategy for a value investor? If they're so good at finding undervalued companies, they should be good at spotting the overvalued ones too, right?
That's a really interesting point. You'd think that short selling, betting against companies you think are overvalued would be a perfect fit for value investors. But a lot of the investors in this book, they actually try to avoid short selling.
Really? Why is that? It seems like it would align perfectly with their whole approach.
Well, they argue that while it might be easy to spot companies that are overpriced, it's really hard to predict exactly when the market will correct those prices. Even if a company's valuation is, crazy high, there's no guarantee that bubble's going to burst anytime soon.
Ah, so even if you're sure a company is overvalued, trying to time the market and short sell their stock could backfire big time.
Exactly. Remember that saying, the market can stay irrational longer than you can stay solvent. And being on the wrong side of a short squeeze, where the stock price suddenly shoots up even though everyone's negative on it, that can be devastating. It can wipe out years of gains. Value investors, they generally prefer to play that long game, wait for the market to catch up to their insights.
It's a good reminder that even the smartest investors in the world, they can't predict everything perfectly. It's about focusing on what we can control, like our own research and our own decisions.
Couldn't agree more. Instead of trying to outsmart the market, value investors, they focus on understanding those businesses and buying them at a price that makes sense. It's about patience, discipline, thinking long term.
This has been an amazing deep dive. We've covered the basic ideas, the different strategies, and the mindsets of some of the most successful value investors out there. So as we wrap up, what would you say is the most important thing for our listeners to take away from all of this?
I think the biggest takeaway is this. Value investing, it's not just some set of rules or formulas you can follow blindly. It's a way of thinking, a philosophy that's all about thinking for yourself, doing your research, and having the guts to go against the crowd.
It's about blocking out all the noise and hype and focusing on what really matters, the true value of a business. It sounds like it's a journey, a process of constantly learning and adapting. After all, the market's always changing, right?
It is. And to be a successful value investor, you have to be curious, you have to keep learning, and you have to be willing to change your approach as the market changes. It's all about discovery and getting better over time.
Well, thank you so much for walking us through this deep dive into value investing. I feel like we've learned so much, and we have a whole new perspective on how to invest for the long haul. Any final words of wisdom for our listeners before we go?
I would just encourage everyone to take what they've learned today and start applying it to their own investing. Don't be afraid to, challenge your own assumptions, dig into the research and trust your gut. And most importantly, remember that value investing is like a marathon, not a sprint. It's all about being patient, sticking to your plan, and staying the course even when things get a little bumpy.
This has been an incredible journey. We hope it's inspired you to learn more about value investing and how it can help you build a stronger financial future. Until next time, happy investing, everyone.